Ladies and gentlemen, good day and welcome to India Pesticides Q4 FY26 earnings conference call hosted by Dolat Capital Markets Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Viral Shah from Dolat Capital Markets Private Limited. Thank you, and over to you, sir.
Thank you, Rutuja. Good afternoon, everyone. On behalf of Dolat Capital, I would like to thank the management of India Pesticides Limited for giving us the opportunity to host their Q4 FY26 earnings conference call. From the management team, we have with us Mr. Vishwas Swarup Agarwal, Director, Mr. D.K. Jain, CEO, and Mr. S.P. Gupta, Chief Financial Officer. Without further ado, I would like to hand over the call to the management for their opening remarks, post which we will open the forum for the Q&A session. Thank you, and over to you, sir.
Thank you, Mr. Viral. Good afternoon, ladies and gentlemen. I hope you and your family are doing well. I take the pleasure of welcoming you all to the Q4 FY26 conference call of India Pesticides Limited. I trust you have reviewed the financial statements and earnings presentation uploaded on the exchanges and our website. FY2026 has been a defining year for India Pesticides Limited as we continue to strengthen our operational foundation, expand manufacturing capabilities, and deliver strong financial performance across business segments. A key milestone during the year was India Pesticides Limited crossing the INR 1,000 crore revenue mark for the first time, reflecting the company's strong execution capabilities and expanding market presence. Consolidated revenue of the year grew by 27.9% year-on-year to 1078 crores, while EBITDA increased by 44.7% to 194 crores. With EBITDA margins improving to 18%, PAT for the year was 120 crores, reflecting a growth of 45.8% year-on-year. These results reflect our focus on operational efficiency, disciplined execution, and strengthening our integrated manufacturing platform. Across the global agrochemical industry, business conditions have gradually improved compared to the previous year as channel inventories normalize and demand visibility improves across several international markets. At the same time, ongoing geopolitical tensions in the Middle East have resulted in periodic disruptions in global logistics and supply chain planning, leading customers to increasingly prioritize dependable and diversified sourcing partners. Customers are increasingly prioritizing reliable supply partners with strong manufacturing capabilities, regulatory compliance, and backward integration. India is steadily emerging as a preferred sourcing destination under the global China Plus One strategy, creating long-term opportunities for companies with strong technical expertise and consistent execution capabilities. On the operational front, the company witnessed strong volume growth across key product categories, reflecting improved capacity utilization and strong order execution. Domestic sales during Q4 FY26 increased significantly to 183 crores compared to INR 118 crores in the corresponding quarter last year, largely driven by strong demand for herbicides and intermediates. Overall, the company achieved approximately 30% volume growth during the quarter, supported by higher production levels, efficient execution, and sustained market demand across domestic markets. From a business perspective, IPL continues to maintain a differentiated position within the agrochemical value chain through its expertise in complex generic molecules, process optimization, and backward integration. Our long-standing relationships with domestic and international agrochemical companies continue to support growth across more than 35 countries. Export revenues contributed approximately 39% of total revenues during FY26. Despite temporary pricing challenges in select exported products arising from geopolitical developments, we continue to engage actively with customers across Europe, Australia, North America, and South America to strengthen market presence and expand product opportunities. As part of our strategic growth initiatives, we continue to strengthen our manufacturing infrastructure and integrated operations during the year. Development work at the Hamirpur facility progressed steadily and supporting infrastructure already established and operational blocks moving ahead as planned. The facility provides a significant pathway for future capacity expansion and incremental growth opportunities over the coming years. Additionally, we commissioned an intermediate plant towards backward integration of one of our herbicides using in-house indigenous R&D technology, supporting supply chain stability and improving cost competitiveness. Within the formulation segment, the company continues to witness strong operational progress, supported by expanding market reach and improved utilization levels. Our formulation capacity has now scaled up to 10,000 metric tons, supported by a distribution network operating across 18 states through 24 depots. The integration of technical manufacturing with formulation capabilities continues to provide operational synergies, better market responsiveness, and strong customer engagement across domestic markets. Our commitment towards research and development remains central to IPL's long-term strategy. Our in-house R&D and project engineering capabilities continue to support process innovation, yield improvement, cost optimization, and development of new molecules and intermediates. During the year, companies received multiple product registrations across domestic and international markets, strengthening the future pipeline and enhancing our ability to address evolving customer requirements across geographies. Looking ahead, we remain focused on scaling our manufacturing capabilities, strengthening backward integration, and expanding our domestic and global presence. The company continues to evaluate growth opportunities across technical, formulations, and specialty chemistry while maintaining a disciplined and sustainable approach towards expansion. With improving market conditions, ongoing strategic investments, increasing utilization levels, and continued focus on innovation and operational excellence, we believe IPL is well positioned to sustain growth momentum and create long-term value for all the stakeholders. Thank you. Now I will hand over the presentation to Mr. D.K. Jain. Thank you.
Thank you, Vishwas-ji. Good afternoon, ladies and gentlemen. I take this pleasure in welcoming you all to the Q4 FY26 and yearly earnings conference call of India Pesticides Limited. At IPL, our priority during the year remained focused on strengthening operational efficiency, improving utilization levels, and expanding integrated manufacturing capability. Despite external market challenges, we continue to execute our strategic roadmap with discipline while maintaining a balanced approach across domestic and export markets. Our focus on backward integration, process optimization, and customer alignment continue to support sustainable growth and improve competitiveness across key product categories. During FY26, we successfully maintained and strengthened our market position across several existing products, supported by strong domestic demand and improved export traction. Domestic sales during FY26 increased significantly by more than 50% to INR 183 crores compared to 118 crores in the corresponding quarter last year, largely driven by strong demand for herbicide and intermediates. Exports remained stable despite selective pricing pressure in certain products arising from geopolitical factors. On an annual basis, we have achieved and exceeded our target revenue of 1,000 crores. Our revenue stood at 1,078 crores against 843 crores YOY, showing an increase of about 28%. In terms of expansion, our capacity enhancement initiatives are progressing steadily in line with planned timelines. Development work at the Hamirpur facility continued during the year, with supporting infrastructure and operational blocks moving ahead as planned. The facility provides a strong pathway for future capacity expansion and specialty product manufacturing. In addition, we commissioned enhanced capacity of an intermediate plant towards backward integration of one herbicide using in-house indigenous R&D technology, supporting our supply chain stability and reducing dependency on imports. From a business operation perspective, Our formulation segment continues to witness strong traction supported by improved market reach and increased utilization levels. Formulation capacity has now scaled up to 10,000 metric tons, enabling the company to better leverage its in-house technical capabilities and strengthen responsiveness towards domestic demand. We also continue to strengthen our distribution network across India, supported by 24 depots and over 340 sales personnel operating across key agricultural markets. Our commitment during research and development continues to remain central to IPL's long-term growth strategy. During the year, the company has received many registrations across domestic and international markets, strengthening the future product pipeline and market opportunities. Our in-house R&D and project engineering capabilities continue to support process innovation, cost optimization, and development of differentiated molecules aligned with evolving customer requirements. Sustainability and community development continue to remain integral to our long-term vision. During the year, we strengthened our ESG initiatives across environmental management, renewable energy usage, waste management, and operational safety standards. Our manufacturing facilities continue to remain globally recognized certificates across quality, environment, and occupational health and safety standards. Through our CSR initiatives such as Samagra Sudhar and Chuppi Tod Halla Bol projects, we continue to support rural development, education, women and child welfare, healthcare awareness, and community engagement programs across multiple regions. These initiatives reflect our commitment towards responsible growth and creating a positive long-term impact beyond business operations. Looking ahead, we remain optimistic about the long-term opportunities for the company, supported by improving market conditions, increasing utilization levels, and ongoing strategic investment across manufacturing and backward integration. With a diverse product portfolio, integrated manufacturing value chain, and continuous focus on innovation, India Pesticides Limited remains well positioned to sustain growth momentum and create long-term value for all our stakeholders. I now pass on to Mr. S.P. Gupta, our CFO, to take you through the financial details of the quarter. Thank you very much. Mr. Gupta.
Thank you, sir. Good afternoon, ladies and gentlemen. Thank you for joining the India Pesticides Limited conference call to discuss Q4 and FY26 results. Taking you through the financial highlights for the quarter and full year. For Q4 FY26, total revenue was 271 crore, reflecting a growth of 28.5% compared to 211 crore in Q4 FY25. EBITDA for the quarter increased to 46 crore from 35 crore in corresponding quarter last year, registering a growth of 31.1%. Profit for the quarter was 31 crore, reflecting a growth of 40.6% YoY, with PAT margins improving to 11.3%. For FY26, total revenue increased to 1,078 crore, as against 843 crore in FY25, reflecting a growth of 27.9% YoY. EBITDA for the quarter for the year was 194 crore, registering a growth of 44.7%, while EBITDA margin improved to 18% from 15.9% in FY25. Net profit increased to 120 crore as compared to 82 crore in previous year, reflecting a growth of 45.8%. The overall performance was driven by improved capacity utilization, strong domestic as well as overseas demand, and operational discipline across the business. From a geographical perspective, domestic revenue during Q4 increased significantly to 183 crore as compared to 118 crore in Q4 FY25, supported by strong demand for herbicide and intermediates. Export revenue was 84 crore during the quarter as against 89 crore in Q4 FY25, slight decrease due to geopolitical issue in March 26. For FY26, domestic revenue was 649 crore, while export contributed 408 crore. maintaining a balanced market mix across geographies. In terms of product mix, revenue from technicals and formulations stood at 744 crore and 311 crore respectively. On the balance sheet side, company continued to maintain a strong financial position with disciplined working capital management and low leverage. Net working capital days improved to 223 days in FY26 from 254 days in FY25, while ROC improved to 16.8%. Capex budget for 26-27 of India Pesticides is 45 crore and for 100% subsidiary is 90 crore. Funding for these capex will be mainly through internal accruals. With continued emphasis on strengthening our product portfolio, cost optimization, and disciplined capital allocation, we remain confident of sustaining growth momentum and delivering long-term value creation for all stakeholders. With this, we would be happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Hello, am I audible?
Yes,
Yes,
hello.
you are. Please go ahead.
Yeah. Good afternoon, sir. Congrats on good set of numbers. Couple of questions from my side. So first of all, you did allude that demand continues to be good. So given the current environment and the cost inflation in terms of raw material and freight, so what kind of price increases which we have taken, say, till March and post-March, and at increased prices, the demand continues to be strong. So typically, this is due to the inventory running out, or is it due to China also increasing prices on various products now? If you can share some more insights on this.
Sir, actually, China is also increasing the price because of the overall geopolitical situation across the world. The prices are slightly changing on daily basis. But we also have discussed with our customers, and we have tried to pass on the cost differential to our customer, and we have been successful in convincing them for some of the products. And we feel that we should be able to maintain these prices in the coming months.
So what is the price percentage increase as an average on the entire portfolio basket?
Entire portfolio is very difficult to tell because some of the products, the increase is slightly more, and some of the products, the increase is not that significant. Because that depends upon the raw material which is getting involved in these technical products. And basically, what we feel that the sulfur-based products have slightly increased more. So there we have to discuss more with our customers, especially for the products where the sulfur-based products are used as the raw materials.
So this 30% volume growth which we have done, how much of it could be due to the new products contribution, including contribution from the Shalvis block which we started in last year, and also the contribution from PEDA, particular contribution, what was it like in FY26, and how do we look in FY27 for contribution from Shalvis block and also PEDA?
Shalvis, now we started one of our technical products, and though it started a bit late, but we have a contribution of about 4 to 5 crores of revenue from Shalvis this financial year. And of course, the volume increase has come from our intermediate PEDA and Petilachlor, that is the herbicide. which we introduced last year with its backward integration facility, and that has contributed significantly to our increase in the revenue as well as volume.
I understand in quarter three, PEDA had done about 50-60 crores. So what was it like in quarter four, and what is the expectation for this product going ahead in FY27?
So FY27, I think we will be utilizing the full capacity of the product because we increased the capacity last quarter, which was commissioned only in March. So we hope that this year we should be able to utilize fully. So this year also will be better than last year.
That will give an incremental sales of about 150 crores roughly from this product itself?
Very difficult to tell exactly the incremental number, but it will be certainly better than this year.
Okay. And sir, with regards to the Japanese partner scale-up, we had spoken about, the gradual scale-up. We started in FY24, FY25, FY26 was supposed to scale up. So how do we look at going ahead with regards to our Japanese partner scale-up?
That is going on well, sir. Actually, we are having regular discussions with our Japanese friends, and they have given the forecast for this year and for the next year, which is almost 30% more than last year. And we are also discussing one more molecule with them. So we have already submitted the samples, and we are awaiting the feedback from them.
Last question, sir. With regards to Shalvis, the one block which has started, what kind of contribution do you see that block, given that you will see a ramp up this year? And also you had planned a second Shalvis block to start somewhere in September, October 26. So
yes. Yeah. See, Shalvis, we already have started one technical product which has given us a volume of about 4 crores this year. But next year, I think we should be able to get at least 25 crores from that molecule. Plus, we are adding 2 more molecules this year. So they will also contribute significantly. So we expect Shalvis revenues to be in the range of at least 70 to 80 crores.
And the second block to start in, say, October?
Yeah, I am assuming that it will be operation by September, October. So including that, it will be around 70 to 80 crores, including the second block.
And the demand continues to be strong at the current pricing levels?
Yeah. Demand is okay. I think demand, there is no problem on that count. There is not much of a variation in the price for these molecules.
Sure. Thank you, sir. All the best.
Thank you. Thank you.
Thank you. The next question is from the line of Vidisha from C.R. Kothari and Sons Stockbroking Private Limited. Please go ahead.
Good afternoon, sir. Sir, I wanted to know, could you just repeat what was the revenue contribution from the new Shalvis facility?
It was 4 crore during the financial year.
Okay. And so in FY27, you plan to commercialize additional 2 blocks, right? So what is the revenue contribution expected from that, and which products will be manufactured?
No, that's what he said. Just now we answered. The revenue from the Shalvis facility will be around 70 to 80 crores in this financial year, FY27, including the new block what we are going to construct.
And so what kind of margins do we expect next year and working capital cycle?
Margins, our margin range is we have projected 18 to 20% EBITDA margin. So margin will be in that range only. And our net working capital days has now improved to 223. There is a slight scope for further improvement, maybe by 10 to 12 days less by financial year 27. We have to keep higher inventory since now the demand is coming. Our customer, they are demanding at the frequent interval. Earlier, they were giving us quarterly planning. Now they are buying on a spot basis. So we have to keep inventory slight at a higher level.
Okay, understood, sir. And what is the CapEx plan for FY27?
For CapEx plan for India Pesticide is 45 crore, and for our 100% subsidiary, it is 90 crore. And mainly it will be funded through internal accruals. We may take a small loan in our 100% subsidiary.
All right, that answers my question. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Naitik Mohata from Sequent Investments. Please go ahead.
Hi, sir. Good morning, and thank you for the opportunity. So my first question would be, for Predilachlor and PIDA, the combined capacity that we had expanded last year, so that is about 8,500 metric ton, right? So what kind of utilization are we seeing from that facility right now?
The capacity utilization, because this is a seasonal product, we may have to stop the plant for about 3 months period. So roughly it will be around 70 to 75%.
Okay. So sir, the 3-month stop, this comes during which quarter?
Normally it will be from, you can say, August, September, October.
August, September, October. That's it, sir. So, sir, so currently, I think post the anti-dumping duty on the product and the main season for the product being April, May. So, are we seeing any imports for PIDA or Predilachlor in India, or now it is completely being catered by domestic players?
I think it is mostly catered by domestic player. Maybe some small import may be there in very small quantity. Some time back, some people might have imported long back, so they may be there, but otherwise it is primarily by domestic production. At least that has been our contribution for Make in India effort, that we have been able to replace this product totally from import.
That's good to hear, sir. So, sir, for Q1 and for this season, so are we expecting some big ramp up in our Predilachlor sales?
No, now I think this capacity what we have now established, that should be reasonably sufficient, because 1 or 2 more producers could come, so it will have some leeway for them also. So we should be able to completely cater the Indian requirement by indigenous production.
Okay. And sir, under the current increased raw material pricing that the industry is facing, so have we also taken any price increases for these products?
We have to take, because the raw material costs have already increased, so that price increase we have to take, and we have been successful. In some of the cases, our customers have agreed as the price differential, so that we are able to maintain the same ratio of margins, roughly.
That's very helpful, sir. Thank you. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Manish Badani from 361 Capital. Please go ahead.
So thanks for the opportunity. I just have 1 to 2 questions. So first question that I have is this climate monsoon. So they have forecasted that the rainfall will be below normal long period average. I think around 94%. So how you look at the situation, and given the geopolitical situation, then this climate forecast, so are you intact with your guidance of 3,000 crore revenue by FY31? So these are the 2 questions from us.
Yeah. See, we know that IMD has given a forecast of reduced rainfall this season from 6 to 8%. But the previous history, what we have gone through, there was a news item in the papers that in the past also there has been occasions where the rainfall was less, but the overall production did not get suffered. The overall production actually was slightly more than the previous year by 1 or 2%. So we feel that these 6 to 8% below normal rainfall should not significantly affect the overall production unless the rainfall is very diverse and very scattered. Or this, there could be some effect of the El Nino, what has been talked about nowadays. So that effect is not very clear. Some people say that it can give a very high rain, some say that it can give drought conditions. So that is very difficult to predict as on today. But barring these, I think the overall production should remain intact.
Okay, got it. And regarding the guidance that you have provided, the 3,000 CR kind of a revenue by FY31, so are you intact with that guidance, or is there any kind of a change?
No, we are very much intact, and we have a plan to achieve these 3,000 crores by March 31. So that plan is already in place, and we are working very rigorously on that plan.
Okay, sir. Thank you so much. Very helpful. That's all from my side.
Thank you. The next question is from the line of Yogan Jeswani from Mittal Analytics. Please go ahead.
Hi, thank you for the opportunity. Firstly, congratulations to the entire team on achieving the 1,000 crore milestone.
Your voice is not clear, sir.
Could you please be a bit louder, please?
Yeah, is it better now?
Yeah. Yes.
Yeah, I'm saying thank you for the opportunity and congratulations to the entire team for achieving the 1,000 crore milestone. And it's a very good set of numbers that we have reported. So, sir, just couple of questions. On the Hamirpur expansion that we are explaining, the two molecules that we want to start off in this year, are these totally new molecules from what we have in the current product basket, or are these similar to what we are already producing in Sandila?
No, they will be entirely new molecules, and we are not producing in our Kandila or Devarod unit. They will be in addition to these molecules.
So, sir, like how we have seen in past, the molecules that IPL usually produces, not many players in India are there and very few players globally. So, are these two new molecules also something similar, or are there enough producers of it in domestic market already?
Sir, I think even with these two new molecules, there are very few producers in India. And I think one of the products we will be the first to produce in India.
Got it, sir. So, sir, if broadly you can share what kind of market size these two molecules would have, like you explained, you will be targeting 70-80 crores of top line from these molecules, but broadly, what would be the market size of these domestically and globally?
The market size of these molecules are relatively quite large, sir. We are expecting hardly about, say, around 10% of the market share.
With 70 crore, you're saying?
Yes.
Or overall once you scale it up?
Yeah, about the 70 crores, we expect about 10% of the market size, because this is a herbicide and it is being controlled by one of the multinationals. So we should be able to get around this number.
Got it. And this would be a domestic product, sir, or these will be export?
Primarily, it will be for export. And we are checking with our Central Insecticide Board authorities whether we can introduce that in India.
Got it, sir. And sir, second question would be on Pretila and Peda. So like you were sharing that there are more players likely to come in for these for both these things. So are you seeing any competition coming in now, or do you still see that the margins would be maintained for this season as well? A broad guidance from your side?
The margins would be more or less same. We are not working on very high margins, so everybody who is going to produce, they will also would look forward for this range of margins. And of course, Pretila, the margins are slightly lower than our overall average. We are getting better margins in other products, but it is a volume-driven game, so we get good revenues in this.
Got it, sir. And sir, on your Sandila plant, what can be the potential of it given the small capex that we'll be doing again this year?
Because now Sandila site is more or less full. There is no further space available for expansion. So this year we would be putting up one intermediate and one technical grade product there. Plus we will be augmenting the existing plant for small capacity additions or whatever additional requirements to improve the overall efficiency. We will be adding some facilities there. Hence the CapEx is slightly low. We are adding some balancing equipment to some of our products to augment the total capacity.
Got it, sir. That's it from my side. I'll get back in the queue. Thank you and all the best.
Thank you. Thank you, sir.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Hello. Hello.
Yes, sir.
Yeah, namaskar, sir, and thank you firstly for the opportunity. Sir, as you have alluded in your opening remarks that exports were on the lower side because of the geopolitical setup. So currently, sir, if you could just throw some more light how the current business environment has shaped up for this current quarter and some more thought on the same.
Sir, export was slightly less. Actually, what happened last quarter, because of our one of the major products is domestic oriented, hence the domestic sales were dominating, exports were slightly less. I think hardly 5% less than the last quarter. And this quarter also we feel it will be quite reasonable. We are going reasonably good in export also. So, but the ratio between domestic and export would be similar to the last quarter.
Okay. And sir, taking into account the backward integration, the introduction of new products and the current setup, what is our expectation in terms of the incremental turnover, increase in turnover or the trajectory that we are anticipating for the current year, including how will our margin shape up with the type of pressure we have on the RM? If you could just give some more color on both these aspects.
Sir, we
on our revenue and EBITDA margin.
We are expecting a revenue increase of about 15 to 20% as we have given the earlier guidance also. So that expectation we are having even for this year. And for backward integration, with backward integration, we are able to maintain our margins, even though the raw material costs are slightly more, but with the backward integration, we are able to overall maintain our margins.
So EBITDA margin of 18% hold good, sir, for this year also?
Yes.
Okay. Sir, when we look at our capital work in progress, the closing balance is at 68 crores. And Gupta ji, as you have mentioned, sir, that we will be spending 40 crore on standalone and 90 crore capex on the subsidiary. So what will we attribute this closing balance of 68 crore to, and when will this get capitalized?
Out of 68 crore, mostly it is for our 100% subsidiary Salvage. India Pesticide has only 18 crore of CWIP. Majority is in Salvage. So once our second plant becomes in operation in Salvage, it will be capitalized. For our new capital work in progress, some part may be capitalized in Q4 and balance will be capitalized in FY27-28.
Okay. And sir, for the borrowing part also, we find our the non-current liabilities or the long-term borrowing, if I could use the term, at 31 crores. So we have drawn funds, a long-term fund, long-term borrowing already. And at what is our blended cost of funds, sir?
We have taken term loan for our new 100% subsidiary. It is around 27 crore. And our cost is around 8% for this term loan.
Okay, sir. And for our working capital, what is our cost of fund?
It will be slightly less since we are borrowing a lot of short-term fund against our FDR. So we are paying 50 basis point over FDR. So it will be, I think, blended cost will be around 7.2 to 7.3% for working capital.
Okay. And when is our credit rating due, sir? What is the current rating?
Current rating is A+, and our rating will be due in, I think, September only.
Right, sir. Right, sir. So I'll join the queue and all the best to the team, sir. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Vidisha from CR Kothari & Sons Stock Broking. Please go ahead. Vidhi, please go ahead with your question. Your line is unmuted. Vidhi, may we request...
Hello, I'm audible?
Yes, now you are. Please go ahead.
Yes. Sir, you had earlier guided for 3,000 CR revenue target for FY28 and 29. So, sir, can you elaborate on the roadmap for the same? So now, Shalvis, we can expect it to ramp up to approximately 200 CR by FY28. Then, your current facility can, how much can it provide at its peak, and where will the rest come from?
3,000 crore turnover has been guided for financial year 31.
Yeah, by March 31, we expect to reach 3,000 crores, and thereby we have got plans already in place. In Shalvis, we expect the total revenue by March 31 to be about 1,000 crores, and rest we will be generating from our existing plants at Deva Road, Sandila, and our formulation facilities.
Okay, so yeah, our existing plants can go up from currently 1,000 CR to 2,000 CR, and the rest 1,000 from Shalvis. Is that understanding correct?
Yes.
All right. Thank you.
Thank you. The next question is from the line of Aditya, an individual investor. Please go ahead.
Hi. Congrats on the good set of numbers. My question is that given this ban on, paraquat across India, do we have any products that can fill this gap? Thanks.
No, I don't think our product range has any product which can substitute paraquat. I have doubt. We have to check. Because we have an herbicide primarily used for the rice field. But we have to check whether it can be used in place of paraquat. We are not very sure.
Okay, thanks.
Thank you. Participants who wishes to ask a question may please press star and 1. The next question is from the line of Ajay Desai, an individual investor. Please go ahead.
Yeah, good afternoon, sir, and congratulations on great FY26. Yeah, sir, my question is, regarding the dividend policy of the organization, because we see 75% dividend being paid, and current year, with the kind of profitability we had, which is 120 crores, we would have given easily 2 rupees minimum dividend. So any policy, sir, we follow as the payout to the profit?
We have a dividend policy which is providing 5% to 15% of net profit. As you know, we have a lot of capex planned for our subsidiary, and our turnover is growing, so we have to fund a lot of increased working capital through our internal accruals. So because of all these factors, we have taken decision to continue earlier dividend payout.
No, sir. The reason I'm asking you is because this gives a wrong message to the market. And effectively, if we are earning EBITDA at 18% and our debt at a zero level, negligible debt, we would have easily taken, and debt and utilize it, and future expansion also we can definitely build around some portion on the debt side. But then then even if we like FPO.
Sorry to interrupt you, Mr. Desai, but your voice is breaking, sir. We are unable to hear you clearly.
So now it is clear?
Yes, please go ahead.
So, I think from business side, we can get. Yes.
We are not able to hear you again, sir.
Sir, what I'm saying, that we are from the business side, we are doing great. I strongly feel. Only thing is from the investors' value creation point of view, we are lacking heavily. And, sir, like FP, which happened at 296 rupees, still we are struggling at 50% price, where there is a big, and this was, investors are suffering, neither in not getting anything in terms of dividend, not even getting anything in terms of, value appreciation. So probably you will have to give message to the market. Otherwise, it's 5 years, like from 21 to 26, investors losing money or not able to. And when the market went through the roof, investors of India Pesticides could not get anything, sir.
Sir, this is a very, very difficult question what you have asked, because that depends upon the market conditions. We have conserved the funds just because to overall increase the investor value, in the sense that we don't take loan, but we try to improve upon our working and the revenues by internal accrual. Taking that view, we have taken this decision, and I think if you see in ultimately the investor value will increase by conserving funds. 50 paisa more or 25 paisa more dividend will not significantly make investors very happy.
Sir, I think, anyway, sir, I leave it up to you. You are a better judge. But then investor value creation should be one of the key responsibilities, which I probably
think.
What
we are trying to do. We are trying to increase the overall revenue. We are trying to increase the profitability. We are trying to invest. Whatever we are earning, we are investing. So that is the best way to increase the overall worth of the company.
Sure, sir. But sir, then the FPO itself was wrongly priced at $300, because post that hardly investors had been able to see that kind of valuation. So probably the 700 crores taken out by the promoters was not a correct stuff. So anyway, sir, I leave it up to you. Thank you, sir.
Thank you.
We can look at buyback also and try to give some confidence to the market, sir. Yeah. Thank you, sir.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Sir, only a concluding question. Given the current geopolitical setup in terms of severe disruption in the supply chain aspect, especially crude related, and also in all aspects of the supply chain, how are we insulated? Or if you could just give us some understanding, how is the space currently facing the vagaries and prepared to face these challenges that will or may not occur going ahead? If you could just give your a remark on the same.
Sir, you are absolutely right. The situation in terms of supply chain is very critical. We have done some long-term arrangements with some of our suppliers who are able to bring the material to us in time. Plus, for the local supplies where we don't keep long inventories, there we are able to sustain because of the continuous supply, though at a slightly higher price. So, and we have discussions with our customers to manage this increase in price. So that is how we are able to maintain, and we feel that in the coming quarter also we will be able to do that. And the critical raw materials what are required for our long-term perspective, that we have already arranged.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to management for closing comments.
Thank you very much for sparing your valuable time. If you have any further questions and queries, please do get in touch with our investor relation team. They will be happy to give you the information. Thank you very much once again and have a good day.
Thank you. Ladies and gentlemen, on behalf of Dolat Capital Markets Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.